Good morning and welcome to this Wednesday, September 29th, 2021 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, we've got futures pointing at least to an early rebound. We'll see what happens. We had a rough day yesterday, a lot of selling in the market, but futures, at least at the open, look like we'll probably get a little bit of a rebound. Dow Jones futures currently up 100 points. Well, when I say currently, this is probably just maybe 5-10 minutes ago when I looked. S&P 500 up 18, NASDAQ up 80. So on a relative basis, we're seeing the NASDAQ get a little bit more of a rebound, but of course, we've seen more selling in the NASDAQ recently. I think a lot of it can be pinned on the 10-year Treasury yield. Traders do have a short-term memory, pretty good one. They don't have a great long-term memory, or maybe they just don't have long-term knowledge, but they do remember, short-term. And it wasn't that long ago, if you recall, Treasury yields were going up, and the big drop in growth stocks, the technology names, some of the communication services, internet companies, many of those companies got hit when rates, the yields were going up. And, it makes some sense. I'm not going to say it doesn't make sense when you got yields rising. That will cut into the future earnings growth, that revenue stream or the earnings stream, when you discount it back, is impacted by higher yields. But if the higher yields are reflecting a stronger economy, then we're going to have also higher earnings down the road. So which is more important, the higher earnings or the higher interest rates where you have to discount those earnings back? That's the debate that goes on. I believe that the growth stocks win in the end, but in the short term, there's no holding the market back when it wants to pull back and wants to sell off, wants to consolidate. That's what it does. And, the market's not going to go up every day, every week. And so I think that's what we're seeing. I think this could be an ABC correction. We'll talk about that in just a minute. But before we get into any of that, let me take you over to Earnings Beats. For those of you who are new, always like to start off the show just letting you know that we do have a free newsletter. If you go to earningsbeats.com, got that green button right there, you can start a no-cost trial, which is a 30-day trial to our paid service. But if you scroll down, you just want to learn a bit more about us and how we approach the market, you can subscribe to our free Earnings Beats Digest newsletter. All it requires is a name, email address, hit that subscribe button. 3 times a week, we'll get this out to you, Mondays, Wednesdays, and Fridays. Normally, we get it out by 8:30 a.m., unless I'm just dragging my feet and I don't get it done in time. But normally, it's out by 8:30 in the morning, about an hour before the market opens. And again, that's Mondays, Wednesdays, and Fridays. No credit card required. You can unsubscribe at any time. So easy peasy. We'd love to have you as part of our community. And we are about to make a pretty big announcement about an event that we're going to have in a couple of weeks. It's going to be a free event, and we will be announcing it, and we'll be announcing it to all of our members. But if you're not part of our membership, we'll also be announcing it in the Earnings Beats Digest newsletter. So, and everybody in that's a subscriber will be invited. So that's the other reason you want to be in the Earnings Beats Digest if you're not a member of Earnings Beats, because when we do have these free events, that's where we reach out to. We reach out to our community. So anyhow, just wanted to point that out. Let's see. Let's head over. Excuse me. Let's head over to take a look at what happened. The daily market recap from Tuesday. It was a bad day. The Dow Jones Industrial Average down 570 points. The S&P 500 down 90. The NASDAQ down 423. So on a percentage basis, that 2.83% drop was the largest among our major indices. Mid caps fell 41 points, small caps down about 20 points. So they fell about the same as the Dow on a percentage basis. So small caps, mid caps, and the Dow did the best, but no one did well. None of these groups did well. Looking at the sectors, the only sector to go up yesterday was energy. It was up much more in the morning, but it did sell off throughout the day. We saw it finish higher. It's up about 1/3 of 1%. But the other 10 sectors were all lower. led by technology, which was down almost 3%. Both semiconductors and software had a rough day on Tuesday, leading technology lower. Communication services down 2.44%. Even a stock like Google, which seems never go down, went down. Internet stocks went down. Discretionary down almost 2%. Healthcare down 1.7%. So it was definitely a big move to the downside. And when I mentioned earlier that I think it's an ABC correction, when you go up and you set a high, a lot of times what you'll do is you pull back once, you'll bounce, and then you'll pull back a second time. Some usually lower than the first one. So your first leg down is A, your bounce is a B, and then this next drop is a C. I think that's what looks like what we're setting up for. And as far as, when are we done with this selling? Well, I think if we can get back past the top of that B, then I think that would negate the pattern at that point. But until we do that, we've got to clear that and the 20-day moving average on our major indices. And you can see that the right side or this bounce, if you will, but this move back up was held back by the moving averages. The Dow, you can see the 20 and then the 50. With the S&P, both the 20 and the 50 were right there. You can see that the 20 and 50 are pretty close together. Right now, the 20 days at 44.38, the 50 days at 44.43. So the 20 is moved below. So we have a death cross. Now, some look at that and say, oh my gosh, death cross, we could have, huge selling. A lot of times you get crosses and moving averages when you're just going through consolidation. So I wouldn't get overly excited about this move to the downside. I'm not seeing any other signals that tell me that this is going to be a steep correction, or certainly not a cyclical bear market. Cyclical bear market would be a 20% drop. Correction would be a 10% drop. I don't believe we're going to see either one. There is one technical indicator that I'll show you in just a bit that tells me that perhaps we could get a 10% correction, but I just don't see it going into the fourth quarter. That'd be very unusual. It's not that it doesn't happen. Recently, remember 2018, the trade war, we had a very rough fourth quarter. So I never say never with anything with the stock market, but from a tendency standpoint, that would be very unusual, I think, to see a big sell-off in the fourth quarter. So I'm going to stick with, and we are still in the month of September, by the way. I haven't moved into the fourth quarter. So I think we're going to probably see a little bit more weakness, even though we're showing some positive futures this morning. I think we'll see some weakness and maybe take out that earlier low, and then we'll see what happens. And I say that because no one ever knows for sure. But I do believe that we are going to rally back and set new highs in the fourth quarter. The NASDAQ, you can see with that drop, looks like we're trying, at least initially, to hold 14,500. We were down just a little bit below that in August, and then you had this double bottom here. But you can see these patterns, even on the sectors here. You can see the first drop down, the bounce, and then the second drop. So it's like A, B, C. The XLC, A, B, the B was very shallow, and now C coming down. Not so much with discretionary, because discretionary just set a new high. So of these three, I would say discretionary definitely looks the best right now. A month ago, I wouldn't have said that. I would have said it would have been either technology or communication services. The discretionary was improving, but hadn't broken out yet. So again, it's the rotation that takes place that we have to be aware of. Healthcare, you can see a slight move up B, and they're already in a C. Move to the downside. Seems like 125, where we had some prior tops, got close to that in July. Seems like that's where we're headed. We've seen some of the biggest selling in healthcare last week or so, last 2 or 3 days in particular. A lot of selling in that area. All right, 10-year Treasury yield. Let me get you an update here. From an economic perspective, we do have one report coming out later. It's the August pending home sales. Expectation there is for it to rise 0.9%. July, we saw a drop of 1.8%. So this is still a little bit in the rear view mirror. I mean, here we are getting ready to go into October, and we're getting an August pending home sales report. But it's better than some of the other home construction reports that go back like into June or July. Seems like a lot of the home construction reports are very dated by the time they come out. All right. As far as the 10-year Treasury yield goes, I mean, Talked about the consolidation, waiting to see if we broke above 140 first or 113 to the downside. Well, that's been answered. Clearly, we moved to the above 140, and it was a couple of days ago. I think maybe on Monday, or maybe it was even last Friday. I talked about the breakout and said, financials. That's first thing comes to mind for me when I see the 10-year Treasury yield do something technically that's bullish. Then I think financials, and look what financials are doing relative to the S&P 500. This is almost, I'm not going to say they're lockstep, but they're pretty close to lockstep. When the 10-year Treasury yield's rising, financials tend to outperform. When you are falling, financials tend to underperform. And that's the general rule of thumb. So while we're in this uptrend, expect financials to outperform. If we do pull back, we're getting a little bit of a pullback today. Right now, we're just down a little over 1 basis point. But if we pull back maybe to that 20-day, that pullback's likely to coincide with profit taking in the financials, especially banks and life insurance companies. So those are some things to watch for. Now, the industrials finally took off. Talked about this yesterday, last couple of days, really, that we weren't seeing industrials doing well on a relative basis. And you might not have seen that yesterday because everything was down. Transports was down, everything was down. But this is measurement of relative strength, not absolute strength. So yeah, industrials went down just like everything else. But when I went through the worst performing sectors, notice I didn't talk about industrials. As a result, they outperformed on a relative basis. So they started to show strength. So not exactly what you want to see, because you actually want to make money in the group. But yesterday would have been a day, if you were in industrials, you would have lost less money than in some of the other aggressive areas. All right, moving on to talking technically, I thought what we do first is just look at the S&P 500. So here's that A, and then there's the B back up to the moving averages and what looks like the start of a C. Now, we haven't, if we lose 4,300, that was the low. Let me give you the exact number. If you recall last Monday when we had that big drop out of the gates and we had, I don't know, maybe in the first 30 minutes, the Dow lost 1,000 points, if you remember. S&P got hit pretty good. We went down to a 43.05 low. So movement below 43.05 would be the indication that we're into the C leg of this ABC. And again, potentially, maybe it's worse than what I think. I believe it's an ABC correction. And that typically happens in the month of September. I mean, nothing is out of the ordinary from a seasonal perspective. But coming off of this, I think you're going to see a pre-earnings run to the upside like we typically do. So the question for me right now is, number one, can we get back through the recent high to negate this pattern? Or do we go through 43.05 first? Right now, we're just in that range. So let's see which way we go. Based on what I'm seeing and based on what we typically see, I'll be surprised if we don't go down and take out that 43.05. Won't be shocked because we're in a secular bull market and we see a lot of bullish stuff take place during secular bull markets. But just based on the huge move we had, the first initial pullback, the volume that we saw, the rise on lesser volume, the pick back up to the selling with increasing volume again, it's just kind of given it that flavor like we're going to go lower. So then the question is, well, how much lower do we go? If we don't hold 4,300, do we test 4,250? Do we test, I don't know, 4,180? Do we go all the way down to, just below 4,100? Do we test the breakout at 4,000? I mean, all of those are legitimate questions. A lot of times when the market sells, and when it sells off, especially when the volatility is picking up, the sell-offs, if you haven't noticed already, are much faster than the gains. We go up, it takes months to go up a few hundred points. And then you go down about, a week, you lose those, potentially, you could lose those few hundred points. But the thing I said earlier, there was one technical indicator that's got me a little nervous, and it always makes me a little nervous. And that's as we were going up over the summer, we had a negative divergence on the weekly chart. So the S&P was going up, and you can see the negative divergence. Now, the reason that I'm not saying, hey, we're going to have a big sell-off from here is I've seen these negative divergences not really play out before. I mean, you can go back to 2017 when we had a really strong market, and look what was happening. Same thing over the summer months. We had this big move up. had the PPO falling, so we had a negative divergence. We started to sell off. This one was in August, got down to that 20-week, and then the fourth quarter, we just took back off again to the upside. And look what happened to the PPO. That negative divergence was eliminated. A lot of technicians that go back and look at the negative divergences, they only look at the ones that work. They don't look at the ones that don't work. Divergences, in my opinion, are very important, but they're secondary indicators. They're not primary. I mean, imagine back in May of 2017, moving up, breaking out above 2,400 and looking at this negative divergence and saying, I'm getting out. In fact, I'm going to short the market because we've got this negative divergence. It's got to go down. And look what happened over the course of the next 8 or 9 months. I mean, we went from 2,400 up to 2,900 in 8 or 9 months. That was a 25% move. Yet, if you had listened to the negative divergence, if that was the only thing you were focused on, you would have been on the wrong side of the trade throughout the entire period, or at least until we finally put in a new high in December. And as fate would have it, a month later, that was the top for a while. So I see this and I see it's a negative divergence. You know, we had a breakout in November right here. And guess what? We had a negative divergence on the weekly chart. What happened? But you look back and you don't see it now. Why? Because the PPO ended up going higher and it eliminated it. If we go back up to 4,800 on the S&P or make a move toward 5,000 and this PPO turns higher, anybody that's Monday morning quarterbacking is going to look back and not see a negative divergence. But clearly there's one in play. So I recognize the negative divergence and I know what can happen with negative divergences, but they're not my primary indicator. They're a secondary indicator. There's something that's telling me, hey, it's possible that we see more selling. And if we finish this week below the 20-week moving average with a negative divergence, the odds are greater that we will go lower, but not guaranteed. And once again, I mean, that same scenario basically, well, we never had the positive or the negative divergence at this point, so I shouldn't say that. But we've had situations in the past where you go down below the 20 and then you come right back up again. Just get these head fakes. Market's full of head fakes. And if you trade frequently, you know exactly what I'm talking about. I mean, I had one yesterday. I actually wrote about it in the daily market report, OII. I mean, I traded this yesterday when it came down, I don't know, about 14, 15, something like that. Ended up getting stopped out when it went below 1390. I mean, it looked like we had a big breakout. Volume was picking up. This is an inverse head and shoulder. So you make a move, you come down, you put in a left shoulder, neckline, head, neckline, right shoulder, breakout, increasing volume. I took a chance. I thought this thing was going to run. It came back down. I mean, head fakes are everywhere. And OII today might take off and go to 18. But for me, it's about managing risk. I can deal with a, 3%, 2-3% loss. But if this is a top on this failed breakout and we go all the way back down to 11 or 12, those types of losses are hard to recover from. So I usually, if I see something like this, big reversal into the close, false breakout, I just lick my wounds. I don't care what happens the next day. All right, let's keep moving on. I want to look a little bit across the pond. Talk a lot about the U.S. and I don't focus a lot outside of the U.S. because the U.S. is my expertise. I could tell you what the charts are doing in Germany. I could tell you what the charts are doing in China, but I can't tell you much about the government, what's going on, and the regulations and how that's going to impact stocks. I mean, I just don't focus on that part of the world. So I can, to me, the basic question is the DAX outperforming the S&P 500? Should I be interested in investing outside the U.S.? And here you can see this is a daily chart going back last year, and the DAX been going up, sideways consolidating throughout the summer. But down here is the DAX relative to the S&P 500. We started off a year ago way up here, and now in September, even though we've been going down, the DAX has been going down more. And so on a relative basis, you can see we've been in this downtrend. Now you can push this out to 5 years, And you can see the DAX has been going up, setting new highs, but look at the relative strength. Since 2017, Germany has been underperforming the S&P 500. Now, it got hit harder in the pandemic than the US, but it also rallied back out of it stronger on a relative basis before, over the last 15 months or so, starting to decline again on a relative basis. So I don't know much of what's going on in Germany. I'm not going to claim to be an expert in Germany. But what I can tell you by looking at this one chart is that the US has consistently been outperforming German stocks. And so for that reason alone, I'm not going to be interested in going outside the US. Not until this trend begins to change and we start to see an uptrend. I mean, all I see is lower highs and lower lows all the way throughout this entire chart. Until that changes, I wouldn't be interested in the DAX. So how about the other areas of the world? I'm just going to stick to the weekly so we can go through these a little quicker here. The Hang Seng. Well, we set a high in 2018 that we haven't gone through. So you can imagine what the relative strength is going to look like here. How about the Nikkei? Oops, need the dollar sign. So the Nikkei has been much stronger, as you can see, breaking out to new highs just recently again. And in September, definitely has been doing better. And you see that reflected right here in the relative strength. But middle of August, we were at a multi-year low. So, you know, you've got the Tokyo Nikkei, which has been performing great here over the last few weeks, showing some strength. But the long-term picture is very, very weak. So again, I'd stay away from the group until I start seeing relative strength. This would have actually been a little bit encouraging to me because you cleared these highs, and there's another failure. This is a different kind of a failure, a relative failure, but they're all over the market. And when you do fail, you've got to be prepared to take action. Here, we failed not only that, but continually underperformed over the 6-month period. But now we're starting to strengthen again. And the last one I'll show you is the Shanghai, China. And here you can see we did break out recently to new highs, but once again, look at the relative strength. I mean, it's this reason alone why I continue to favor US stocks. It's not because of anything fundamental or I'm going and doing hours and hours and hours of research. I don't have to do hours and hours and hours of research. Everybody else does it for me. Wall Street has a lot of analysts and researchers that go back and look at all these different things, and then they decide where to put their money. And all I have to do is look at this chart to see where they're putting their money. I got all those folks working for me. Relative strength is very, very important. Okay, so I'm not really seeing much strength outside the US, at least not in the major indices that I like to follow. Let's take a look at some of the key intermarket relationships. One of them that I would like to follow is the XLY XLP. And it's very simple why. The US GDP, it's been estimated that it's made up of 2/3 consumer spending. 2/3 consumer spending. Now think about the different types of consumer spending that we have. We have discretionary spending. So, you know, when you feel good and you want to go get that $5, $6 latte at Starbucks, you got that kind of consumer spending. And then you got the kind of consumer spending where you go and you buy a tube of toothpaste, you know, Colgate, Crest, whatever. Two different kinds of consumer spending. One is the kind where you feel really good about things. You're not trying to conserve. You're not worried about your job. And you just, you know, when you want something, you just go and buy it, whether it's that Starbucks latte, whether it's a new car, even home builders. That's part of consumer discretionary. You know, you're thinking about a new house. You're not going to buy a new house if you're worried about whether or not you're going to keep your job because the economy's so tight or the economy's weakening. But when the economy's strong, you're absolutely going to be thinking about buying that new house. And that shows up in all these economic reports. But this ratio, following consumer discretionary versus consumer staples, to me, is one of the most important ratios to follow. And I follow it at a minimum once a week. It's a weekly chart. Usually, if I haven't looked at it all week, I'll look at it over the weekend, just to keep myself up to date. To me, this is more important than a lot of the fundamental data that comes out. I listen and I read the fundamental data, but it's the reaction to the data that's more important to me. And so as we've been going up since 2013, we broke out into this secular bull market. I call it 2013. Some people say it was 2009. The bottom was 2009, but you didn't know that the 12-year sideways consolidation was over until April of 2013. That's when we broke out. We took out the S&P high in 2000 and 2007. So April of 2013 is when we broke out. Well, guess what? That was about the time the XLY broke out versus the XLP. And notice that when we did pull back in 2016, we essentially went, this was a little bit of a head fake. And I've said before, over the last 8 or 9 years since the secular bull market began, the one time that I probably was the most bearish was the beginning of 2016, because I started seeing signals like this, where we were breaking down below key support levels, but we came right back up. So it was one of those head fakes. And look at what happened afterwards. There's no denying you're in a bull market when you start seeing this kind of behavior in consumer discretionary. Now, we went through a period of consolidation. We had the trade war. We had the pandemic. And so we lost ground, but we didn't put any kind of a lower low in. We made this huge move and we pulled back. And right now we're in the midst of another one of these huge moves, which I think indicates that we have a very sustainable bull market. All right, next up, we'll take a look at the transportation stocks versus utilities. Now, transportation for a while was very weak, but prior to that, transportation versus utilities went from a 5-year low to a 5-year high in 1 year. Very strong action. So when we were coming out of the pandemic and I started to see this kind of behavior in transports versus utilities, that was telling me Wall Street loved the economy going forward. Saw the same thing in the XLY, XLP. That's why when we get these pullbacks in the market, I say, listen, we're still in a bull market. It has nothing to do with whether the S&P 500 is going up or down. It has a lot to do with these relationships, these intermarket relationships. We've got transports, again, you might not realize it, but transports versus utilities starting to make a sharp move to the upside. Part of it's because of rates moving up, but I don't care what the reason is. I like to see the ratio, this ratio moving higher. The market tends to do much better when this ratio is moving higher. Same goes even more so with the XLY, XLP. All right, let's move on to earnings spotlight. First, I'm going to show you Micron. Micron came out with their earnings last night. They beat $2.42 versus $2.33. I'll give you the update here this morning. Micron down 2.64%. So what's reported and the reaction, not always the same. Micron's been in this downtrend. I'd be careful until it starts to show stronger action. This morning, CTAS, Cintas, reported they are up 2%. So they're going the other direction. This is a stock that's been uptrending, pulled back near support, and now starting to, or at least trying to move a little higher here in the near term. Jabil, used to be Jabil Circuits, now it's just Jabil Inc. Reported they beat $1.44 versus $1.36. Market didn't care. Down 2.5. I still see an uptrend though. So I think any kind of a pullback, closer you get down to this 58, 59 area right in here, the better the reward to risk, in my opinion. So I like the stock down there. All right, let's move on to the 3 you must see, and then we'll wrap this up. I'm going to start off with APA Corp. Just looking at this bearish engulfing candle right at the 24 level, which was the prior highs. I just think you have to respect a level like that until you break out. I'm not saying we're going to go lower, but $24 clearly is the big level on APA. And until we get that breakout, I would be careful on it short term. Next up, Moderna. I mentioned earlier, healthcare has really been struggling the last few days. Look at Moderna. It was up above 450. 3 days later, 384. We've seen this before on these big pullbacks. I think 350 is great support on Moderna, price support. So, and even 375, you got some support. So that's a range, if you like Moderna, where I would consider building a position. Last one I wanted to point out was Net, which is Cloudflare. This is a stock I pointed out to members a couple of weeks ago. It's a portfolio stock. And I said, you got to be careful. It had a negative divergence. I said, short term, we might see some weakness. So when the market presented itself and we started seeing many of the technology stocks moving lower, communication services and so forth, look at what happened with a stock like this that's got a weak divergence. So it took a hit. I think it's probably going to find, I'd look for a reversal around 110. And if not 110, then 100 becomes a pretty good support, this 96 to 100 level. So right in there. AD line, by the way, remains strong, even with the selling last couple of days. So that's something worth watching too. We get a big reversal. You could see that AD line turn right back up again. All right, that's it for me. We did go a minute into the open. I'm trying to finish these before the market opens. I'll keep working on it. But we'll get a quick update on what's going on in the market. Right now, NASDAQ up 73, down 92, S&P 15. So we are getting a little bit of a bounce, but look at the Dow here and look at the steep drop and where we are on this rebound. I mean, it's weak, but it's early. So it's really, we'll see what happens throughout the day today. If we lose 43.05 on the S&P 500, that's when I would be more concerned than the near term. Until then, you know, I'm not convinced that we go lower. I think the odds are it's pointing in that direction, but you got to get confirmation. 43.05 is the level I'd watch. Everybody have a great day. Tomorrow I'll be back over at Stock Charts TV at 9 a.m. You can listen into my recorded show tomorrow morning at 9 a.m. Eastern by clicking on Stock Charts TV anytime around that 9 o'clock time frame or after. Everybody have a great day. Be back tomorrow. Happy trading.